I do like to spend the first portion of the show just talking about what I saw happening in the stock market this week. And if you kind of look right over Eason's head there, you can see this week has really just been kind of sideways.
Yeah, it's
Uh,
down 0.5% for the week.
yeah, so up a lot last week.
Hmm.
So there's a couple things there that I see. Number one, a huge up week and having a sideways next week. That's good, actually. Even though it's down a little bit, it's better than what we have seen quite a few times where it retraces so much of that. You can kind of see over my head here, just to the side, there was like 4 big up days. It retraced that almost immediately. So we're not doing that, right? So that's important. And the market seems to be kind of bouncing here on the S&P 500 between 3,900 and 4,000. Right?
Yeah, it's a lot of mixed news, I would say, for the week. You have the seasonal trend from the election. We got job reports, spending, and then the Fed's coming out with their comments, and it's kind of been a back and forth.
Yeah, because there are all those issues are, on one side of the argument or to the other, and the argument is inflation. Really, I mean that's the key thing everybody's looking at. So we got retail sales, earnings, and reports that came out. They were strong. It's consumers doing well. Now they're borrowing, yeah, because we're seeing really big run-ups in credit card debt. American consumers are really good at buying. So a lot of pent-up demand after sitting around for a few years, and people are still buying. And then, of course, we saw the unemployment report come out, which was low. Both of those say inflation could go higher, right? So the market doesn't like that. At the same time, we saw actual inflation report from CPI last week. Came out better than expected. Still high, but better than expected. And this week we saw wholesale inflation come out. It was high, but still better than expected. So they're talking about what they call peak inflation, where things have maybe peaked out and we're slowly going to start to come back down as far as that goes. And then, as you mentioned, the Federal Reserve is out in droves right now. So one of the things that is inflationary is the stock market going up. And so they are very interested in trying to help that, come back down. And they have been through most of this time frame, and they're fairly good at it. They're coming out talking about higher peak inflation rates. Some of them were really high and kind of unexpected that were, shown and what have you. So, their next meeting isn't until December 13th, but this is their way to kind of come out and try to push down on the market. And it's been fairly effective as far as that goes. So what we're seeing right now, I think, is sort of just a battle between this good news for inflation and then this bad news for inflation. And so it's not clear. Yes, inflation looks like it might be coming down, but then there are all these other pieces that are precursors to the next reports that are going up, like jobs and job growth.
Yeah, with the Fed's comments, the betting odds or the expectation for the 0.75% raise in December is up to 25% from 16% after the last couple of days of comments.
Yeah, that's a good point, and that's, still likely to be a half, but the more the market expects a 0.75 point increase, for example, the more the market will pull back. And so the higher that odds get, the more the market will pull back, or at least go sideways in this case. So these are all important components. I think almost all of the major indicators that I look at for recession are showing recession. The 3-month versus the 10-year Treasury, the 2-year versus the 10-year Treasury. The leading economic index was just released today. It's now down for 8 months in a row. Very good track record at predicting future recessions. We have the ClearBridge, report on recession report that's been showing recession for quite some time, and so these are all components that are out there. Everything showing recession. Looks likely that we'd have something probably in the second half of next year.
Yeah, and we've had kind of like a mixed bag, I would say, from earnings reports. You had Walmart earlier in the week that's saying they're looking their expectations are quite, positive. But then the following day, Target says we're heading for recession and they're not doing well.
Yeah, it seems to be certain companies, because we got good reports from Lowe's and all of these different, retailers, and then a couple companies stand out. Target and Williams-Sonoma really got hammered, and so it's an environment right now that's very difficult to manage, and a couple companies are having a harder time managing. And Target's actually usually pretty good in this category, but Walmart did really well here, and Target not so much. So there is some mixture of what's happening there. I think we're kind of in this kind of transitionary zone. If you look at it, probably inflation does start to come down, and probably the job market starts to weaken, and retail sales start to weaken at some point in time. Earnings start to weaken, because of this recession that comes. I guess the next question is, is it already kind of baked into the pricing here? Because the market already knows all these things. It's looking ahead 6 to 18 months. We're very close to the 200-day moving average. Is this the beginning of the next new upward trend, or are we going to fail like we did with these other ones? And so that's really, because right now, if you look at what the market's doing, it's fairly stretched out to the upside. I have a whole scorecard, and say -4 is the highest it gets. It's at -3 right now, so it's not completely stretched out like it was back in August 16th in that last big run up there. So maybe a little bit more room to grow before it gets stretched. And then, so far when the market gets stretched out to the upside, it's gone back. And then it gets stretched out to the downside. And that's been our market this year, overall down, but these little peaks and valleys. And the run between the valleys and the peaks are 10 to 18%. It's huge.
Yeah, you can if you're a good trader and you're somehow able to time all the peaks and valleys, you could be making some serious money during a down year like this.
Yeah, exactly. And that's the difficult part of this, is that, it's hard to stay out of the market when it runs up 18%. It's hard to stay in the market when it's down 28 from highest to lowest point. And so this is a difficult place. It's one of the reasons why we have a third of our exposure to stocks in the market right now, and not all of it, is just because there's just so many indicators showing possible issues. Yet you still probably need, at least in my opinion, some exposure here until we see this play out and how this goes. Does this break through the 200-day moving average? Does it break through that trend line, or not? And does it reestablish a new primary trend? Then you want to get back in. And again, be aware that the market is looking forward 6 to 18 months. And so you'll see all this news coming out and inflation and all that, and the market's going in the opposite direction of what that news might be, because things look bad. Inflation's, still here. Recessions are coming, and the market goes up and up. And I've seen this game before. So doesn't mean that this will be the time that happens. We might need to see. We never had what they call full capitulation, right? And that's one of the things that the market's been looking for. That we don't have to have it, right? We did have this is a fairly big downturn already, from top to bottom there. Bottom was October, 12th. But nonetheless, right now, the, 1/3 exposure, market's a little bit stretched. There's one other good thing that's been happening. The China, iShares China ETF is up like 19% just this month, right? And that's because of some conversations and, little hints that maybe they start to deal with zero COVID in a different way. So far, we actually haven't seen that. And I don't know how they would deal with it in a different way, personally, because they're kind of stuck with an older population and not enough vaccine beds, and hospital capacity for that. But there are some pieces pushing to the upside quite nicely. And there are other pieces that are giving some warnings here that things could get worse. So we do have the PCE report next week, which is the favored inflation view for the Federal Reserve. That'll be for last month. It comes in late, but that could be better than expected. That could help the market. And then of course we get the next CPI report on December 13th. So
will there be big volume next week, because it's a holiday week for the U.S. stock market? So usually trades during that week, can we read much into it?
No, you have to be careful, because usually the volume does drop down, and actually sometimes that creates higher volatility. And so you can get these kind of moves one way or another that aren't that critical as far as that goes. So I don't know if next week's going to tell us a lot about what goes on with the market. I am always really careful around lower volume time frames. Wait until maybe after to see what happens. So but it's been a good run. We're up, roughly 10% from the bottom there in October. That's great. Let's just see where this goes as far as that goes.